what actually happens the moment a government prints new money. The US government created $4 trillion in 2020, not over a decade, not gradually, in 8 months. And here's the part nobody tells you. They didn't print a single bill. This isn't a video about inflation or economics textbooks. This is about the exact sequence of events that happens between the moment a government decides it needs money and the moment that money appears in the world. Because the answer is so much stranger than you think. When most people imagine money creation, they picture a printing press, giant machines churning out fresh $100 bills in some secure government facility, stacks of new currency being loaded into armored trucks. That mental image is about 200 years out of date. The truth is that 97% of all money that exists right now exists only as numbers in databases, digital ledger entries, and the process of creating it doesn't involve ink or paper or serial numbers. It involves a keystroke. But here's where it gets interesting. The government doesn't just add zeros to its own account. That's not how it works. There's a specific choreography to this, a bizarre financial ritual that happens between institutions, and understanding it reveals something uncomfortable about the entire system. Let's walk through it, step by step. Say the US Treasury needs money. Maybe there's a pandemic, maybe there's a war, maybe Congress just passed a spending bill and now someone has to pay for it. The Treasury doesn't have a magic money button. So it does what anyone does when they need cash. It borrows, it issues bonds, government IOUs, promises to pay back the money later with interest. Now, here's the first weird part. The government's own central bank, the Federal Reserve, can buy those bonds. The government essentially borrows from itself. But to buy those bonds, the Fed needs money. So what does it do? It creates the money out of nothing. This isn't a conspiracy theory. This is official Fed policy described openly in their own documentation. They call it expanding the balance sheet. Here's the literal process. A Fed official opens a computer system. They type in a number. They credit that amount to the Treasury's account. That's it. The money exists now. It didn't exist 30 seconds ago, and now it does. No vote, no physical backing, no gold in a vault somewhere shifting around to accommodate this new claim on resources, just an entry in a database. And immediately that money starts moving. The Treasury spends it. Stimulus checks, infrastructure contracts, military budgets. The money flows into the banking system, into businesses, into people's accounts. $4 trillion of new purchasing power created by typing. Now, you might be thinking, if creating money is that easy, why doesn't the government just do this for everything? Cancel all taxes, print infinite money, problem solved. And this is where the mechanism reveals its flaw. Money is not wealth. Money is a claim on wealth. Think of the economy as a pizza with 8 slices. There are 8 people, and everyone has one token that lets them buy one slice. The pizza represents all the real goods and services available: food, housing, cars, labor, everything that actually matters. Now, the government creates 4 new tokens and gives them to 4 more people. There are now 12 tokens, but the pizza still has 8 slices. What happens? Prices adjust. They have to, because now 12 people are bidding for 8 slices. The tokens become less valuable. Each token buys less pizza. This is inflation, not as a theory, but as a mathematical inevitability. And here's the darker part. The people who get the new money first benefit the most. They spend it before prices have adjusted. They buy assets, real estate, stocks at the old prices. By the time the new money reaches regular workers, prices have already risen. Their wages buy less than they did last year. They're poorer even if the number in their bank account went up. The mechanism transfers wealth from the people who already had tokens to the people who got the new tokens first, from savers to borrowers, from the powerless to the connected. It's a tax that never had to be voted on. During 2020 and 2021, the narrative was simple. The money printing was necessary. Emergency measures for an emergency situation. Temporary stimulus to keep the economy alive. And in the moment, it felt like magic. Stock markets hit record highs. Housing prices soared. People who owned assets got dramatically richer, on paper at least. But the consequences didn't stay theoretical. By 2022, inflation hit levels not seen in 40 years. The price of everything from gas to groceries to rent increased by double digits. The Federal Reserve, the same institution that created all that money, had to slam the brakes. They raised interest rates, made borrowing expensive, tried to pull money back out of the system. Thousands of people lost their jobs in tech layoffs. Multiple banks collapsed. A regional banking crisis spread through the system. All of this is still playing out. And here's the absurdity. The government is still paying interest on all those bonds it issued. Bonds the Fed bought with created money. So the Treasury collects taxes from citizens, then sends that money to the Fed as interest payments. And the Fed sends most of it back to the Treasury as profit. It's a financial Ouroboros, the snake eating its tail. We're paying interest to ourselves on money we created from nothing. This system exists in most developed countries. The European Central Bank does it. The Bank of Japan does it. The Bank of England does it. And for decades, it mostly worked. Central banks would create money during crises, pull it back during booms. A controlled expansion and contraction. Inflation stayed low. But something changed. Since 2008, central banks have created more money than in the previous century combined. The balance sheets have exploded. What used to be emergency policy became standard operating procedure. And now we're in uncharted territory because there's a limit somewhere. Nobody knows exactly where it is, but it exists. There's a point where people stop believing the money has value, where they realize it's just ledger entries backed by nothing but the collective agreement to keep pretending. When that belief breaks, you get Weimar Germany, you get Zimbabwe, you get Venezuela, wheelbarrows of cash to buy bread, savings wiped out overnight. It hasn't happened to a reserve currency in modern history, but it doesn't mean it can't. So what actually happens the moment a government prints money? Someone types a number into a computer. An account balance changes, and through that simple action, claims on real wealth get redistributed. Winners and losers get selected. The invisible tax gets collected. The machinery keeps running because we believe it will, because we wake up every day and accept that these digital entries represent value, that we can trade our time and labor for them, and they'll still buy roughly the same amount of goods tomorrow. But belief is fragile. Every time a government creates trillions from nothing, the foundation cracks a little more. The pizza doesn't get bigger, but more people crowd around the table. Eventually, someone notices. The question isn't whether this system can create money. We know it can. We've watched it happen repeatedly on scales that would have been unimaginable a generation ago. The question is, how long can you create claims on wealth that doesn't exist before people stop accepting the claims? Nobody knows the answer, but we're running the experiment in real time.